Okay, now we come to the fourth question. How do I tax the little bugger? Now that I've decided I've got a holding company or an operating company, I've decided a business purpose, I've decided the state where I want it to be, and I've decided, okay, this is going to be an LLC, or this is going to be a corporation or a limited partner, whatever the legal structure I'm going to have. Now it's a totally, completely separate question as to how I'm going to tax it. Here are your options. I could tax things as sole proprietorships, as partnerships, S Corps, C Corps, or nonprofits. Those are your options. So could I have, let's say, an LLC taxed as an S Corp? Yes. Could I have an LLC taxed as a sole proprietorship or a partnership or a C Corp? Yes. Could I take an LLC and tax it as a nonprofit? Yep. But again, the legal structure, should I be an LLC, corporation, or a limited partnership, is a completely different question than how am I going to tax it. Let's go through these one by one. The taxation for a corporation is that there's no separate, there's nothing, it's you, remember? And so anything that would happen, all taxable events would show up on your individual 1040 Schedule C. So I don't have to file a new different tax return. I just, for every business, let's say I've got 3 sole proprietorships, everyone would fill out an individual 1040 Schedule C, and I would attach those to my 1040. It might complicate my 1040 the more businesses I have, but it doesn't require a separate tax return. It is a disregarded entity. It's considered that by the IRS, which means it's an invisible entity. This is different than a pass-through entity, like an S corporation is a pass-through entity. A partnership is taxed as a partnership. That's a pass-through entity. They require a tax return, and then it reports all the taxable events that happened in that business, and then those taxable events flow through to the owners. This is different. This is a totally invisible entity. It doesn't mean that there are no tax consequences. It means all of them flow through to the individual owner. In this case, it's you. And so a disregarded entity, all taxable events show up on your 1040 Schedule C. You're limited in the tax deductions you can have. I can't take a big, I can't do big tax returns. I can't take anything. I can't take 100% medical. I'm limited to the tax deductions that I can have. And all income is subject to that nasty 15.3% self-employment tax. So that's the sole proprietorship. That's number one. Number two, tax as a partnership. Now, this is really good for things that you want the passive income. I want real estate, all the passive losses to come through. Now, it is going to file a 1040 schedule. I'm sorry, it's going to file a 1065 tax return and then give a K1 to each one of the individual owners. It's great for real estate. It's great for real estate losses. There are times, even though we're not trying to encourage you to lose money in real estate, but with depreciation deductions, I might have cash flowed positive, but I get this big loss in real estate. On paper, it's a paper loss. We like those paper losses because they can offset other income, other investment income, and sometimes a little bit of your W-2 income. We like those losses to flow through to you and not get stuck in a corporation somewhere. It's generally not a good idea for an operating business. We want this to be for holding companies. Holding companies are generally taxed as partnerships, and I'll get to that in a minute. And you don't have a lot of tax deductions. It's not like you're being taxed as a corporation. It's really a holding company. This is how we want holding companies to be taxed. Okay, then there's a thing called an S corporation. This is, again, we're operating a business, but I want some tax deductions that I couldn't get as a sole proprietorship. So it does file a tax return. It's called a 1020S, a tax return, and then it gives a 10. So it reports all the taxable events that happened, and it gives a K1 form to each one of the individual owners. How are we doing on time? Okay, we got to go a little faster. The profits are not subject, or may not be subject. Okay, the profits are not subject to the 15.3. However, I do have to take a reasonable salary. It avoids the double taxation of a C corporation. And I'm not subject to accumulated earnings taxes, which means in a C corporation or an entity taxed as a C corporation, I can't keep too much wealth in there. Otherwise, I'm subject to that accumulated earnings tax. S corporations, I can keep all the money I want in there, although it might be a dumb idea for an asset protection because we want the corporation to be lean and mean, remember? You're limited to 100 shareholders in an S corp. All right, a C corporation is a separately taxed individual. You're going to file a 1020 S corp. Wow. A 1020 corporation tax return. And then it's going to give maybe W-2. It's going to issue W-2s, or maybe it's going to issue 1099s, but there's no K-1s that are going to go out. Corporate tax rates might be lower, and then the personal returns. So we like that. The fiscal year planning options I could do in a C corporation, which means I'm offsetting the calendar year of my corporation and looking for the very best tax advantages for me. I can income throttle, which means at the end of the year, I don't really need the money. I'm going to keep it in the corporation, pay 21% taxes on it, which might be lower than your individual rate. There's some substantial tax deductions I can get out of a C corporation that I can't get anywhere else. But it does have the potential for double taxation. But I'll tell you, we've run a C corporation for almost 20 years and never been subject to more than $500 in double taxation, because I think we understand how to play the game. We just don't. At the end of the year, let's say there's no profits. I wiped out the corporation. I paid it out in bonuses and in salaries, and there was no double taxation because there was no profits. Okay, well, that's good. I like C corporations too, because when I go to sell a business, you almost always add value to the business by taxing it as a C corporation. It's been audited. It's had outside accounting firms look at it. It's a separately taxed individual. They can show that you've made money. It makes it more attractive when you go to sell this business. I like that. It's also better for acquiring business credit if you're a C corporation. Okay, then there's a nonprofit. I'm not going to go into a lot of details on that. Some great access to grants, donations. You get discounts at the post office for mass mailing. Your credibility goes up when you're a nonprofit. It's not. There's certainly a purpose for a nonprofit corporation, and sometimes we don't tout those benefits nearly enough. Okay, so selecting the tax status, you need to understand that a single member, if you're going to set up a single owner LLC, it is always going to be default to be taxed as a sole proprietorship. However, I could do a single member LLC. It's just me. I own the asset, and I could elect to tax it as an S corp or elect to tax it as a C corp, which means that I'm an LLC, but I get all the tax benefits of a C corporation. But I don't have to do the minutes and meetings and resolutions and stock certificates and the stock ledgers and the corporate formality stuff. Oh, that's cool. Or I could tax it as an S corporation by simply filing an IRS 2553 form. You see, and then the IRS looks at your LLC and go, oh, that's cool. You get all the benefits of an S corp because you're an S corp, even though you're an LLC taxed as an S corp. I could take a multi-member LLC. It's always going to default if you don't do anything. It's going to be taxed as a partnership. However, again, I could file a 2553 or an 8832 form and elect to tax it as a C or an S corporation. And it gets all the benefits of that with very few exceptions. Okay. What if I want to change the tax status of my entity? Well, first of all, once you form an entity, you've got 75 days to file an election. So let's say I set up a new business entity right now. Okay, today is February, 7th, 8th, whatever it is. And I've got 75 days after so I get an EIN number. I'm filling out an SS4 form. I get an election. I get my EIN number. Now I've got 75 days from that day to file an election saying, yes, I don't want to be what you want me to be. I want to be an S corp or a C corp. I can do that. Or I could change the tax status on my entity in the first 75 days of each calendar year. Like right now, we're in the middle. If you've got an existing business, you want to change the tax status, you're right now within that window to be able to do that. Okay, that's good. And again, I could take a sole proprietorship, change it to an S or a C corp. I could take an S or C corp, an S to a C, and you'll notice the arrows that are on the board. The sole proprietorship to an S corp to a C corp. Sometimes as businesses grow, that's exactly how the progression that they're going to go through. They start as a sole proprietorship, but then they graduate to an S corp, then they graduate to a C corp. I will tell you, though, it's very hard to go backwards, to go from a C to an S, from an S to a sole proprietorship. It's not impossible, but you're creating a tax nightmare for your accountant when you decide to go backwards. And sometimes because of depreciation deductions and schedules, that it's next to impossible. Whenever you're going to change tax status, it's always a good idea to get your accountant, your CPA involved, and get their opinion on these tax status changes.